Hey y'all, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're going to be discussing the 10 best companies in the world that I'm investing in. Currently, portfolio value $218,198.71. In this portfolio, I've recently been amassing different positions of the 10 best companies in the world that I have decided. I will discuss what my criteria are. For the last couple of years, I have been investing in ETFs and ultimately switching over to a massive Tesla position. I'm at the point now where my Tesla position is, I got over 800 shares of Tesla, and I've decided that I'm willing to start investing in other companies. The plan moving forward is, including Tesla, I'm going to be investing in 9 other holdings, and investing in these 9 other holdings, we are going to be putting about 10% of whatever I invest in Robinhood into these holdings. For example, so if I invest $1,000, then I'll be putting $100 in each one of the holdings. The only holding that I will not be investing in is Tesla. This is a whole different strategy than I will probably discuss in a later video. But today's video, we're going to discuss the 10 holdings as well as the reasoning behind investing in these 10 holdings. So currently, those holdings will be Tesla, Waste Management, Visa, Apple, JP Morgan, Costco, Microsoft, Old Dominion Freight, Procter Gamble, and Google. In all these different positions, minus Tesla and Tesla, I have invested about $500 in each and one of these positions. Like I said, plan moving forward is to invest about 10% of any money I put into these funds. And now let's talk about what made me look into these companies. The first thing I would like to address is the first thing that I like to invest in terms or picking stocks is company's ability to create free cash flow. If a company creates free cash flow, they're able to use that free cash flow to either invest back into their business by research and development, they can pay down debt, they can pay dividends, or they can buy back shares. Each of these, in turn, brings shareholder value. So that's one of the first things I look at. The other thing I look at is the company's cash to debt ratio. I have a stout belief that if a company has a lot of cash and no debt, it is impossible for that company to go bankrupt. Only companies with a lot of debt go bankrupt. Kind of going through the list, Apple. For the longest time, Apple has just been dominating. They've been a company that's been increasing their free cash flow year over year. They've been increasing their cash flow at a 10% mark over the last 10 years, as well as about 17% the last 5 years. If you look at different cash flow markers, so after paying all their bills, they have $58 billion left after most expenses, $111 billion in free cash flow. That essentially means that they can factor in another multi-$100 billion company cash flow into it. So for example, a company like Broadcom, which is a semiconductor company, they make their net worth is $350 billion. They produce $16 billion in free cash flow. Apple makes 5 times that. You essentially could be 5 separate companies due to the amount of free cash flow that Apple has. So Apple's free cash flow is increasing quarter over quarter, net income increasing, earnings per share increasing, cash to debt ratio. I wish they had a little bit more cash, but cash 48 billion, debt $98 billion. They started buying back shares pretty drastically around the 2020 mark, which you can see around 2020, they've been buying back shares pretty aggressively, as well as an increasing dividend. This is one of the world's best companies. Next company, Costco. Looking at Costco, there's a couple different companies that are their competitors. You could look at Walmart, Target, Home Depot, Lowe's. And one of the things that I like most about Costco is their cash to debt ratio. They have $11 billion in cash, $6 billion in debt, and they have about $2.5 billion in capital leases. This company increased their revenue year over year, EBITDA, and then their free cash flow is a little bit more sporadic, but Costco is one of those companies that just keep making money over time. The retail space is a very difficult space to compete in, but some of the things that keep Costco competitive is that they have their memberships every single year that they harvest. And for the most part, Costco doesn't really make any money on the products they sell. They make it off of those memberships. And what is also nice about Costco is that they pretty much set out to build 20 or 25 new stores every single year. And they're not trying to, expansively or aggressively expand. They're just putting their 25 up every year, make sure those are solid stores, and they just keep growing like that. Net income going up, earning per share going up, dividend increases. So the last 10 years, their dividend growth rate is about 12%. That's insane. That is an incredible dividend growth rate. And I would say anything above 5 or 7% would be a great dividend growth rate. I kind of wish that they would probably buy back more shares, but for the most part, they are running their business immaculately. I'm totally willing to just leave the share count how it is as long as they keep raising that dividend. But again, Costco, another great business. If you compare Costco to Walmart, let's just look at Walmart. Walmart is increasing their revenue year over year. The free cash flow is a little more sporadic. Walmart is increasing their dividends, but this is the secret sauce here. Their cash to debt ratio, 8 billion cash and 32 billion in debt. Again, it is very difficult for a company to go bankrupt if they have more cash than debt. Companies can't go bankrupt if they have cash. Okay. So that is just my take. I think Costco is the better company, and that's why I'm going with Costco. Now, Google, absolute juggernaut. You're probably watching this on a Google product, YouTube. And you should definitely get YouTube Premium because watching YouTube without ads is the best thing ever. So a couple things to think about. Another best company in the world. Revenue increasing quarter over quarter. EBITDA. Free cash flow. Look at the same thing as Apple. $60 billion in free cash flow, and they've been growing 16% over the last 10 years. Incredible rate. Net income increasing drastically, earning per share. And then look at Google's fortress of a balance sheet. Cash, $113 billion, 14 billion debt. Now, I believe Google is going to be one of those companies where they will pay out a dividend in the future. But currently right now they're not. So ideally I make some exceptions to some of my rules. I like companies that have great free cash flow, great cash to debt, but you'll notice that there are some exceptions that I make to some of these rules. I do wish that they paid a dividend or bought back shares, but for the most part, this is a solid company, and moving forward, they're going to keep dominating. There's a common theme when you look at the U.S. stock market or any type of thing in nature. You're always going to notice that there's a select few that dominate. And if you look at the S&P 500, VTI, any of these type of index funds, the majority of the gains are in the top 10 or 20 companies. So if you can pick out the top 10 or 20 companies throughout these ETFs, the ones with the best free cash flow, cash to debt ratios, you can make yourself an outside return. Now, I'm not one of those guys that, does discounted cash flow models or anything like that. But if I did, I'm sure Google and Apple and Costco would definitely be making more money in the future. At some point, I probably will make them, but just going off of the quick fundamental analysis and looking at a balance sheet and some of these fundamental metrics, that you can evaluate how well a company is doing. And I love Qualtrim because they just make it so easy to look at it. Carrying on, next company, JP Morgan. Not a huge fan of banking stocks in general, but let's just go over the fundamentals. I have some moral qualms with JP Morgan. They actually wronged me when I was trying to buy my first apartment with my wife, and we were having issues trying to transition over some of our down payment money. So I have some beef with it, but at the end of the day, it is still a business and it makes a good amount of money. So I had to set my pride aside for this one. But revenue increasing, EBITDA going up, free cash flow a little more sporadic. Banks have a lot more risk associated to interest rates and then different macroeconomic factors. So free cash flow is a little more sporadic, and net income's increasing, earnings per share increasing. Cash to debt ratio is one of the reasons why I'm okay with having a worse or free cash flow. I believe the free cash flow, they're only tracking it for 1 year, up 37%, but cash, $700 billion cash, $400 billion debt, decreasing share count, dividend going up. Just from getting shareholder return, they're doing the right things. But again, not my super top company, but it's up there. Microsoft, very similar to Apple. This is just one of those companies that stays out of the news. Always going to make the revenue increase year over year. EBITDA, free cash flow. $60 billion, massive cash position. I would say even better cash position than Apple. Dividends increasing, share count decreasing. Another great company. And just like I was mentioning earlier, $60 billion in free cash flow. I mean, they essentially can take the next 5 or 10 companies in cash flow combined. Old Dominion Freight Line. One of the things I really liked about this is it's an industrial stock. They move freight around, and comparatively to a lot more industrial stocks, this company actually has a lot less debt compared to cash. You know, if you look at Union Pacific, if you look at 3M, you look at some of these other industrial stocks, they have a lot more debt. This one has a very good cash to debt position, increasing their dividends, share counts going down. I mean, you can see that the revenue is increasing pretty drastically, and their free cash flows are increasing 42% over the last 5 years, which is an impressive number, and they're going to continue to keep growing. So, for example, I was picking between Old Dominion Freight versus Union Pacific. To some degree, freight has to be moved. Rail is always the cheapest route. The only thing I don't like about the rail industry, it is a monopoly, but that's not the part I don't like. The part that I don't like is for it to grow its revenue. Do you see that the debt is increasing year after year? So total debt is $31 billion. Market cap is $130 billion essentially. So almost a fifth of the company's debt. That's not okay. If there is a company that has a higher chance of going bankrupt, this would be one of those companies. Where comparatively, if you're comparing Old Dominion Freight, they have a pretty strong cash position, very little debt, and they're increasing their revenues pretty drastically. So to some point, you know, this to me was the better company, which ultimately makes it one of the best companies in the world. Now, Procter Gamble, kind of what I was mentioning earlier about like the cash to debt ratios. I don't like the amount of debt that this specific company has, but one of the things that I do like about this company, they sell products that people absolutely have to buy. You have to buy laundry detergent. You have to buy deodorant. You have to brush your teeth. Guys have to shave for the most part unless they're growing their beards, but these are all self-care products that ultimately people need to buy. Like, you don't want to be the person that smells. Like, that's just awkward. Revenue increasing for the most part. Free cash flow pretty sporadic, but like $13 billion. You know, this is a $360 billion company. And then if you look at Google or Microsoft or Apple, they're literally tripling the amount of free cash flow that they're making. So just something to keep note. Cash, $8.25 billion, debt, $23 billion. Again, a lot more debt than cash. Not a big fan of that, but you know, I have guidelines. I don't have specific rules that I follow, and you know, I can make exceptions to the rule, and this is one of them. I mean, this company is just they have pricing power. They make great products. I use predominantly a lot of their products for my self-care needs, and dividends going up, share buybacks. I mean, again, you know, the world's best company. I know there's not going to be a lot of companies that are going to come in here and, you know, displace this company. Carry on. Tesla, love it or hate it, they're rapidly growing money. You know, the valuation right now, PE of 78. Of course, it's overvalued. I don't think there's a Tesla investor that says right now that Tesla share price is fairly valued. Now, the thing about Tesla is we're investing for the share price in 10 years, the ability of this company to make money in 10 years, not what is the abilities to make it right now. Increasing their revenue over 60% year over year, free cash flow increasing 67% over the last 2 years. Just like I've been mentioning about all the other stocks, this company truly has zero debt. It has zero debt, $22 billion in cash. Just like we talk about, can't go bankrupt if you don't have any debt. All right. At some point they will pay dividends, and at some point they will buy back shares. But right now they're in the rapid acceleration and growth phase where they're trying to just make as many cars as possible. And then ultimately, once they have the immense car growth and once they kind of stabilize making either 10 or $20 million 10 or 20 million cars a year, they will ultimately use that same technology that they're using for the full self-driving, the real world AI, and create those robots. So if you guys think that I'm saying some crazy stuff, if you just go on the Tesla website or the YouTube channel, you could look up their AI day, and they will pretty much explain some of the incredible stuff that they're working on. But Tesla, another world's best company, no other car company can compete with them. They have higher margins and they're making electric cars cool. And then two more companies, Visa. This is a toll booth company worth $500 billion. I mean, this is a fortress of a stock. Great revenue growth, EBITDA growth, free cash flow, bringing in $17 billion a year. Great cash and debt position, increasing their dividends, decreasing their share counts, working on technologies for the futures, helping mainstream some cryptos as well. So they're definitely in a position where they are investing in the old world, but also working on the new world as well. So great company. Again, one of the world's best companies. And then finally, waste management. Just like I was mentioning earlier, I make exceptions to some of the rules. I hate the amount of debt that this company has. They have over let's just call it $15 billion debt and barely a trickle of cash. And if you look at their market cap is $67 billion and they have $15 billion in debt. A fourth of the company is financed through debt. So for them to make more money, they have to acquire more debt. I don't like that. They are increasing their revenues and their free cash flows and things like that, but they can't do it without increasing debt, and that is a problem to me. Now, the only thing about waste management is we have to get our trash taken. We have to get our trash picked up. It has to go to a landfill. It's got to go somewhere. And ultimately, there's not a lot of companies in the United States or actually even in the world that do it. So there's only a few. It's Waste Connections, Waste Management, Republic, Waste Service. I mean, it's like an all monopoly, or there's like three companies that own the entire market. So yeah, I don't like the debt position, but it's an industry that is not going to be going away. And regardless if we have supercomputers and whatnot, our trash needs to be picked up. Dividends going up, share count going down. I mean, those are the things I like, increasing revenues, but I don't like this debt position. I would like for them to maybe relax with the dividends and share buybacks just to build a little bit of cash position. And once they build a cash position, then they can go ahead and resume dividend payments. Well, they can keep paying dividends, but not increasing the dividend payment. So they could use that same, the money that they would use for the growth to just pay off some more debt. But those are all my different companies. Those are my top 10 companies, the best companies in the world. If you agree with them, let me know. If not, let me know. But to me, those are the ones that produce the most free cash flow, have the best balance sheets, and those are the ones I want to be going forward. So plan, anytime I get any money, 10% of the money goes into each one of these holdings. And then we'll be making a separate video on this Tesla position, this income investing that I'm using margin for. So if you guys like the video, definitely give it a like and subscribe to the channel. And I hope you all have a good one.